The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Carolyn Roth and Steve Sedgwick is out and about this morning. These are your headlines. Israel confirms attacks on Iranian nuclear sites overnight as President Trump keeps the world guessing if America will strike Iran's nuclear sites. Telling reporters in the Oval Office he'll announce his final decision in short notice.
I have ideas as to what to do, but I haven't made a final. I like to make the final decision 1 second before it's due, because things change. I mean, especially with war. Things change with war. It can go from one extreme to the other.
The Fed keeps rates steady, but policymakers signal 2 more cuts by year's end, even as Chairman Powell warns tariffs will lead to price hikes. Here in Europe, we'll get decisions from the Bank of England as well as Switzerland and Norway.
And London's AIM market marks its 30th anniversary with nearly £136 billion raised so far. Now, this amidst concern, of course, about some very high-profile listings and departures from the London market. Well, we're going to speak exclusively to Dame Julia Hogget, the CEO of the London Stock Exchange. We'll do that in around about 13 minutes' time.
A lot of big news of this now, and no doubt our top story is still Iran and what is playing out in the Middle East. But I think the Fed, hugely pivotal for markets too, the fact that they have no conviction around some of their decision making from here.
I mean, the guest on the earlier show, Paul Donovan of UBS Wealth Management, he told me basically the Fed knows as much as Donald Trump about actually getting militarily involved in Iran. So nobody knows anything. There's a huge cloud of uncertainty over everything in the markets right now.
Yeah, big oil supply shock is obviously what the gigantic threat could be. So central banks trying to recalibrate again, giving the moving pieces now around the Middle East. Now, US President Donald Trump says he, quote, may or may not pursue strikes on Iranian nuclear facilities. Meanwhile, Bloomberg reportedly, people familiar with the situation said there could be an attack this weekend, but plans are evolving and could still change. It comes as Israel and Iran continues to trade air attacks overnight. Iran's Supreme Leader Ayatollah Ali Khamenei has warned there would be, quote, irreparable damage if the US intervened in the conflict. Speaking outside the White House, Trump said he was yet to make a final decision and next week would be crucial.
I have ideas as to what to do, but I haven't made a final. I like to make the final decision 1 second before it's due, because things change. I mean, especially with war. Things change with war. It can go from one extreme to the other. War is very bad. There was no reason for this to be a war. I say it very simply. Iran can't have a nuclear weapon. Too much devastation. And they'd use it. I believe they'd use it. Others won't use it, but I believe they'd use it. So that's it. It's very simple as far as I'm concerned. They can't have a nuclear weapon.
This as the Wall Street Journal reports the president has told senior aides he approves of attack plans, but is holding off to see whether Tehran abandons its nuclear program. Just in the last few minutes, the Israeli military said it targeted Iran's Arak nuclear reactor overnight and that it attacked a site in the country's Natanz area. Meanwhile, the Iranian Supreme Leader rejected calls for surrender as the government denied it was looking to develop a nuclear weapon. Western nations have continued diplomatic efforts with both Iran and Israel. The foreign ministers of Germany, France and the UK are reportedly set to hold nuclear talks with their Iranian counterparts in Geneva tomorrow. President Trump has told Israeli Prime Minister Benjamin Netanyahu to continue with the strikes. In an interview with CNBC, the Israeli President Isaac Herzog said the country was not pursuing regime change in Iran.
It's not an official objective of ours. We never said it. What we want is to remove the Iranian nuclear program. However, the more they attack us, and clearly we know that they are badly oppressed, and it's a regime which is extremely oppressive, and the people are badly oppressed and they hate the regime, I think there's a chance for a change that can also bring peace in the region. It's a big deal. And then you will see a real difference in the Middle East. because the source of evil was and always has been in Tehran, because their ideology calls for the destruction of Israel.
Let me take you back to Israel's endgame in Iran, because there was a report that suggested Prime Minister Netanyahu put forward a plan to assassinate Iran's supreme leader, and President Trump pushed back. Is that true?
I have no clue to that effect, and I am not involved in the nitty-gritty of what's going on in the closed rooms. You know, the supreme leader of Iran is the supreme leader of a whole war machine that wants to kill us. And we fight terror all the time. But from that to the conclusion you mentioned, I think there's a big difference.
Now let's get back to our other top story. Of course, the Fed delivered its fourth straight rate hold in an expected decision yesterday, and the median dot plot projection continued to show policymakers expecting 2 rate cuts this year, but there were increasing signs of a split, with 7 officials expecting rates to stay on hold for the rest of the year, up from 4 when projections were last offered in March. In updated economic forecasts, policymakers downgraded their outlook for growth this year and signaled they now expect inflation of 3%, up from the 2.7% projected in March. Now, those projections raised concerns around possible stagflation, with Chair Jerome Powell warning that tariffs will hit the outlook for inflation and have stopped the Fed from cutting rates.
What we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs. Ultimately, the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
And we got further clues on the Fed's thinking in its statement announcing the decision. It said that uncertainty around the economic outlook has diminished, even though it does remain elevated. Now, compare that with May. That was when officials said uncertainty about the path for unemployment and inflation was actually increasing. Now, another line from the Fed's May statement disappeared this time around. Officials no longer saying explicitly that the risks of higher unemployment and higher inflation are rising. All right, let's show you what U.S. markets made all of this. Initially, it took it as a dovish sign and then flipped into a pretty hawkish takeaway. The Dow Jones closing lower to the tune of 0.1%. The S&P 500 closing pretty much flat. The Nasdaq eking out a very modest gain here of 0.1%. Keep in mind, U.S. markets are closed for a public holiday in today's trading session. The dollar was also flip-flopping to some extent. Currently, euro dollar at 114.51, down by 0.25%. Sterling dollar, all eyes on that given the BOE decision later on today, currently lower to the tune of 0.2%, and dollar yen at 145.23. Quick check of treasuries as well. Little movement in treasuries on the back of the FOMC meeting yesterday. The 10-year yield sitting at 4.39%. And this comes as President Trump repeated his criticism of the Fed overnight, claiming Chair Jerome Powell has cost the U.S. billions of dollars by being too late to cut rates. Trump also hit out at Powell during an event marking the erection of the new flagpoles at the White House, saying rates should be 250 basis points lower and suggesting he should lead the Fed.
It's hundreds of billions, it's even trillions of dollars that we're going to lose because of this too late. I call him Too Late Powell because he's always too late. I mean, if you look at him, every time I did this, I was right 100%. He was wrong. Maybe I should go to the Fed. Am I allowed to appoint myself, Doug? I don't know. Am I allowed to appoint myself at the Fed? I do a much better job than these people.
John Brazier joins us now, Portfolio Manager, Palmer Square Capital Management. Thank you so much for joining us. Getting into the weeds on the Fed. I mean, the Fed is not in the business of hypotheticals like markets, and what's becoming clearer now is the impact of the trade tariffs. It's still looking at the scenario in the Middle East, but the trade tariffs really coming into focus, and the message for me was from Jay Powell, somebody has to pay. That effectively everybody that they're talking to is talking about putting prices up at some stage. What does this mean in terms of setting policy for the Fed?
Yeah, it means they want to see more data. I mean, I think that was one of my key takeaways as well. Somebody has to pay, so they want to see whether that's U.S. Retailers pushing that on to consumers, or whether that's absorbed by somewhere else in that import-export chain. And we're not going to know that until we probably get another couple prints from either the CPI or PCE data to really give them comfort that we can lower rates.
As we still tackle this from a big picture point of view, the Middle East situation could have dramatic consequences. I was talking about the range of views on the oil markets, $60 a barrel, the low end $120 if things truly escalate, and we talk about an oil price shock. That is a very different scenario for the Fed to bake into its already fairly shaky assumptions around trade tariffs. Yep. So how do we think about the scenarios?
Yeah, I mean, there's a lot of scenarios. I mean, just with the trade policy as well, there's varying degrees that could show up in inflation data. That's why I think you're seeing an increasingly polarized Fed committee. You know, when I looked at the dots and I saw, 2025, there's now two big camps. There's the no-cut camp, and then there's the two-cut camp. And I don't know which one Powell is in, but it does seem like there's polarization within the Fed on the impact of tariffs and oil market and geopolitics on inflation. But I think both camps want to wait, as long as possible before making a decision. So if we wait until September, which is kind of the base case, you're going to get 3 more CPI prints, 3 more PCE prints, quite a bit of other data, plus Jackson Hole. And so I think both camps are kind of in that wait and see mode still. And even by September, we might even have more delays on tariff policy. It does seem like, that's kind of Trump's MO, is to, get close to something and then delay, not have it actually come into effect. So we'll see.
You got to wonder, though, what have policymakers, not just the Fed, but other central bankers of this world, what have they learned from the past, specifically the pandemic? If you see the sustained oil price shock, or any energy price shock for that matter, you got to move earlier because it may not turn out to be temporary. What's your thinking here?
Yeah, I mean, I think if it's a price spike on the back of increased tensions in Iran, I think the Fed will be less inclined to adjust policy based on something that does seem temporary. But if it is more structural in nature from, I think, the trade policy is something where, if we're really trying to bring manufacturing back to the U.S., actually change supply chains permanently, then that's something that the Fed's going to be more inclined to move towards.
And in the meantime, we're dealing with the S word, stagflation. That is very much the feared word. Is that visible when it comes to the U.S. economy? Because it's been so resilient over the last 2 years. Everyone was forecasting a recession last year. That didn't happen. Do you think, once again, the bias is to the upside of how the U.S. economy and the consumer, of course, which makes up 70%, could come out of this?
I think we're slowing down, but I think if you look at core growth, so like, for example, in the first quarter, GDP data was actually slightly negative. But if you strip out, the front running of tariffs, the import-export sort of noise, as well as the inventory build, core growth was like positive 2.5%. Powell even mentioned it in the press conference yesterday. So core underlying U.S. growth is still pretty resilient. And even the consumer data we're getting is still pretty healthy, despite, inflation coming back, despite the sort of lower income cohort struggling a bit with inflation. But in general, we see growth slowing down, but still remaining, healthy in that sort of 1.5% to 2.5% range.
Well, you've got to ask yourself, where is the US exceptionalism when it comes to growth? There's been a huge amount of diversification happening globally because the market is saying, look, I don't think the US deserves the premium that it's had for many, many years because of that growth story. The chipping away, thanks to all the uncertainty that you've been mentioning on the trade front, even with these decisions sort of kicked down the road, they might not be having a big sort of axe effect on the economy, but they're having a different type of effect because of the uncertainty. That is still negative for the US growth story.
100%. When you look at, to bring it back towards rates and Fed policy, I always try to separate the short end of the curve, which the Fed largely controls, and the long end of the curve, which is a lot more driven by supply and demand technicals. Foreign demand of long-term treasuries is around 15 to 20%. Obviously, we're seeing, or there's anecdotal evidence of, repatriation or de-dollarization happening at a time when we're running 5 to 6% budget deficits, extreme treasury supply, and that's leading to a lot of rate volatility at that long end. So regardless of whether the Fed cuts 2 times or 0 times this year, I think, or we think, you're going to continue to see rate volatility in that long end of the treasury curve and for the European markets too.
So just finally, the BBB, and we're not talking about credit ratings here, I'm talking about the big beautiful bill. What bearing will that have on the curve stateside, given all the other effects that have left investors jumpy? Is the BBB, the signature bill, going to have an impact on the Treasury market?
For sure. I mean, to go back to my earlier point, I think we're going to continue to, we're basically locking in 5 to 6% deficits for at least the next 2 to 3 years. And then, from there, who knows? But we're going to see with that, you're going to see, record Treasury supply, regardless of whether we resolve the trade wars, et cetera. And so that's going to lead to a lot of issuance. And it's going to be hard for the market to absorb that issuance without significant foreign demands, at least staying where they are.
All right.
John, thank you so much for joining us. John Brager with us, the portfolio manager of Palmer Square Capital Management.
And of course, it is not all about the Fed today. We will also be hearing from 3 European central banks today. The Swiss National Bank is first with its decision at 8:30 London time, before the Norges Bank at 9 a.m. and then the Bank of England at midday. And of course, we will bring you the Bank of England's rate decision on decision time today, live on CNBC and the CNBC International Live YouTube page from just before midday London time. And also on decision time, you will of course be able to watch my conversation with the SNB Governor Martin Schlegel as we discuss the Swiss Central Bank's rate decision and outlook.
Coming up on the show, the US weighs a potential strike on Iran as President Donald Trump claims Tehran was weeks away from building an atomic bomb. Plus, it's the 30th anniversary of the London Stock Exchange's alternative investment market, AIM. We will bring you an exclusive interview with London Stock Exchange CEO Julia Hogget. That is right after the break.
Welcome back to the show. The UK is looking to encourage more Chinese listings on the London Stock Exchange as the city grapples with a lackluster IPO market. City of London Policy Chairman Chris Hayward said opportunities could be provided for Chinese firms to list in London by the Stock Connect scheme with Shanghai. Now, the London Stock Exchange's alternative investment market is marking its 30th anniversary amid a backdrop of delistings and collapses. AIM has seen notable successes over the years, though, including airline Jet2 and Fevertree, which have multiplied many times over and has outlasted European equivalents. Steve joins us from the London Stock Exchange. Good morning, Steve.
Yeah, it's really great to be back at the Stock Exchange. I started my career back in 1988 at the London Stock Exchange, so I have a great affinity for the LSE in its various forms as well, as does our next guest. Dame Julia Hogget is the CEO of the London Stock Exchange. Julia, we've spoken several times in the past, but we've never met in person, so it's a real honour and a pleasure to meet you today. So look, before we talk about some of the big issues that you need to face every day in your job, tell us a little bit about AIM as well. We're going to speak to Marcus later on, the head of AIM. So, but it's an amazing institution and has weathered the test of time way better than many counterparts.
Absolutely. Well, firstly, thank you for coming into the exchange. Welcome back.
Thank you.
And thank you for coming to our birthday party.
Thank you very much.
AIM is a remarkable British success story that I think we should celebrate far more. It was designed to be the growth market for the UK and has been a phenomenal engine for growth in the UK, creating 68 billion of value added to the economy, 750,000 jobs in 2023, and over 5.5 billion of tax revenue. Now, that's what markets do, actually. We can talk about them as basis points and big cover ratios, but fundamentally it's to drive capital into the companies, and in the case of AIM, the growth companies in the UK and around the world who come and use AIM in order to enable them to fulfill their ambitions, to create products, to drive growth, to create employment, and to create solutions to people's lives. And that's what AIM has been doing for 30 years, and that's really what we want to celebrate today.
Julia, it seems to me that AIM is a metaphor, is a microcosm of the broader challenge you're facing here at London Stock Exchange, whether it be the small and medium-sized companies, whether it be the titans you're trying to get on the stock exchange and keep on the exchange as well. Yeah. I read the article, which, I mean, you would have read a couple of times, I'm sure, from December the 7th, and the headline was in the Times, Julia is on a mission to save the London Stock Exchange. Does it feel like that every day, given the wealth of news we're getting?
We're on a mission to make the London Stock Exchange the most vibrant market that it can be. That's simply put what we do every single day and what the hundreds of people who work on the exchange do every day. Fundamentally, when I joined the exchange, I said I want to do two things. I want the London Stock Exchange to be a driver of the UK domestic economy and a driver of the UK's place as a global financial centre. I think actually over the last few years, we've got less good at talking about the former and more focused on the latter. And fundamentally, stock exchanges and primary exchanges in any country are there to drive capital into the growth economy. And we have disconnected ourselves as a nation from our market. Retail doesn't participate in regulated markets as much as they do. For example, we have 5 million crypto accounts in this country. And therefore, the average person walking along the street is not necessarily feeling that they've got a stake in the success of British business. And yet they do because they're employed by them. They do because they create growth and other investment in their area. They do because they create tax revenue for them. And so a lot of what we're trying to do is to reconnect those things back together.
Okay, there's a lot to unpack there as well. Why don't I just go directly in here as well? You've got the City Minister coming up later on as well. You and I were talking off camera about the things that Rachel Reeves could do and Rachel Reeves won't do as well. Come on, what's your number? I know you're going to speak to Emma Reynolds, the City Minister, later on, but what is the number one thing this government could do that's in their power to do?
Well, I think fundamentally we've had an enormous reform agenda over the last 4 or 5 years in the UK, more than any other nation in the world actually, and we have really made our markets match fit. The thing that we are most focused on, and I call it the 2 Cs, are capital and culture, is making sure that we're really driving domestic UK capital into risk investments. You know, we talk about risk as a bad thing, but the deployment of risk capital is the thing that's created all the companies that list on this exchange and that have grown our economy over hundreds of years. So it's not a bad thing, it's a fundamental thing that needs to be part of the makeup of our investing capability as a country. We have taken away quite a lot of the structural incentives for the deployment of risk capital in the UK over the last 30 years.
Are you blaming George Osborne for cash ISAs?
But I think we have done this, so it's not as if we didn't used to do this. But we have removed those incentives. And we've also created a language of risk rather than a language of the opportunity that comes from investing. So I've used this phrase a lot, we've so protected people from the downside, we haven't exposed them to the upside. And as a nation, we haven't had a conversation about the opportunity cost of that. So I think that the real ask of government is to think with an investment mindset. They are absolutely focused on growth. And that is about incentivising flows of capital into the UK that is UK risk capital that can drive that growth.
And are you expecting changes to the rules which enable pension funds to take on more risk?
Well, we're already seeing that. You know, between the combination of the Mansion House Compact and the Mansion House Accord, what's happening in terms of the consolidation.
Why are they so low then in the UK?
Well, I think we got ourselves into a regulatory kind of challenge in part in terms of de-risking and the language of de-risking. We also, unlike any other nation, had a radical restructuring of our pension funds when we started closing our defined benefit pension schemes for corporates and turning them into de-risking assets that invested in gilts. Let's be clear, almost no other nation on the planet did that. And therefore we do actually need to make a more overt step back into the incentivisation of the deployment of risk capital because we made such an overt step to reduce the deployment of risk capital with our pension reforms in the 90s.
They're already telling me there's only a limited amount of time. I'll keep them at bay as long as possible, Julia, because this is the conversation as far as I'm concerned. Why are we still seeing a lack of IPOs and concerns about delistings and de-equitisation on the London market?
Well, I think in terms of IPOs, we've seen a downturn globally. The pipeline for London is actually growing pretty rapidly. Now, I know that some of that isn't seen. It's a bit like an iceberg. It's below the surface. It's with the advisors and with the lawyers and the accountants at the moment as firms prepare. But that pipeline is building very rapidly, and from around the world, because I think the reforms that we've seen in the UK has actually enabled the UK to be a really compelling proposition. In terms of delisting, we do know the growth of the private markets and the strength of the private markets. And my view as a CEO of the exchange is not to sort of be King Canute and try and hold that back. It's to recognise that both private and public markets need to work together and we create a funding continuum in the UK.
And is that the Pisces initiative?
Exactly.
Well, then if you have the Pisces initiative, does it undermine AIM? And ergo, is AIM better placed outside of the London Stock Exchange, as a former head of AIM might like?
Yes. So,
there's a line in there.
So AIM is not for sale. We have this vision of a funding continuum in the UK. I think the hardest thing a founder should do is come up with a great idea and figure out how to execute it, not to try and navigate the labyrinthine world of finance. Our job is to create a funding continuum in the UK so you can get on it and navigate your way through. Pisces sits at a much earlier stage of that funding continuum than AIM does. AIM and the main market enable you to raise primary capital. Pisces is purely for secondary. And I think that there is a therefore logical transition between all of them. And we are absolutely committed to the next 30 years of AIM, let alone the previous 30.
When you see a company like Wise, that I've been quietly dismissive of them wanting to go to the US, because this is the company that trades on 30 times forward. Do you think the expectations of some of these technology companies, they're way out of kilter with actually what they can produce in terms of growth, in terms of profits as well? 30 times forward, that's more than most big US tech companies.
Well, I think that illustrates exactly the strength of London.
Yeah.
You know, a company is.
So what are they thinking? Are they deluded?
I think there are idiosyncratic reasons why any company makes choices, and we have to recognise that every company is making a choice for what they believe are the right reasons, and the nature of their cap table is specific to them, and the nature of our rule set and how it interacts is specific to them. So I think I'd treat it as that. But I would take the opposite, which is that Wise is an illustration of exactly what this market can do, and what it can do for the next generation fintechs that are coming up in the UK.
But we just want them to get to FTSE 100, don't we, rather than seeing the de-equitisation? That's the problem.
And actually, to be blunt, those next generation of fintechs are going to find it a darn sight easier to get into the FTSE 100 than they are into any of the major indices in the US. And they will be the national champions for the UK.